You know, in today's financial markets, information moves at the speed of light. But what really happens when a single social media post can spark billions of dollars in trades? When it tests the very limits of a rule book written for a completely different world? Well, in this explainer, we're going to break down the mechanics and the aftermath of one of the most incredible market events of our digital age.
And this is it. This is the tweet that lit the fuse. On January 26, 2021, Elon Musk posted this one word, a mix of GameStop and stonk, which is, just internet slang for stock. It seems so simple, but this message was like throwing fuel on an already raging fire in the market. And the effect? It was instantaneous. Within minutes of that tweet going live, GameStop stock, which was already on a wild ride, shot up another 31%. It was just a crystal clear example of how one person's voice on social media could instantly rally a massive group of investors. Okay, so to really get what was happening here, we need a little context. This whole event was what's known as a short squeeze. Basically, you had a huge group of everyday investors coordinating online who started buying up a stock. This drove the price way, way up, which in turn forced these big institutional funds who were betting the stock would fail to buy shares just to cut their massive losses. And of course, that just pushed the price even higher. Just look at this timeline. The velocity here is absolutely stunning. On the day of the tweet, the stock's already at $144. Then the tweet hits and boom, it spikes. By the very next day, it's closing in on $348. And just 2 days after that one little tweet, it hits its peak at $483. The speed and scale of this was just something else. And on the flip side of that coin, the consequences for the big players betting against GameStop were, well, staggering. Institutional investors were forced to close out their positions, losing almost $20 billion in the process. An event like this, it really shakes the confidence of the entire establishment. Okay, so we've seen what happened, but to really understand it, we've got to dig into the why. You see, these events aren't just random chaos. They're actually fueled by some very predictable, very human psychological patterns. So let's take a look at the cognitive machinery that was at work here. The main engine driving all this is something we've probably all felt. FOMO, the fear of missing out. When people see stories online about these incredible, life-changing gains, the brain can just flip a switch. It's a powerful emotional reaction that can completely override rational thought. And in today's world, the sheer speed and visibility of these stories just cranks that feeling up to 11. Now, you take that FOMO and you pour gasoline on it with something called social proof. These online communities can become powerful echo chambers. When you see thousands of other people all doing the same thing, all buying the same stock, it makes your own decision feel correct. It validates it. It turns what would be a lonely financial risk into a shared collective movement. That's a powerful force. And all of this plugs into these little glitches in our thinking, our cognitive biases. Things like confirmation bias, where you only look for information that agrees with you. Or overconfidence bias, where you start to believe you can't lose. And then there's recency bias, where you assume that just because a stock has gone up for a week, it's going to keep going up forever. Put them all together and you have a recipe for some pretty irrational decisions. So with all this chaos, you might be thinking the market is just the Wild West, right? No rules, anything goes. Well, that's not exactly the case. There's actually a century-old foundation of market regulation in the US designed specifically to prevent these kinds of things from happening. You see, this whole framework was born out of a crisis. After the historic stock market crash of 1929, Congress had to act. They passed the Securities Acts of 1933 and 1934 to restore trust in the markets. The whole idea was to ensure fairness and transparency, and they created the SEC to be the referee.
And the whole point of this legislation, the absolute core idea, was to explicitly outlaw manipulation. The law was written to make sure that stock prices were based on real supply and demand and good information, not on tricks or deceptive schemes.
And that brings us to the central conflict of this whole story. We have laws that were written in the 1930s being used to police market behavior that's driven by 21st century technology, by tweets and memes. And as you can imagine, that creates a really fascinating and very murky legal gray area. So it all boils down to this one really tricky question. When does a tweet from someone influential cross the line from just being an opinion into being illegal market manipulation? And believe me, the answer is not simple at all. The reason it's so complicated is because courts themselves don't fully agree. Some take the bad act view, which says for something to be manipulation, you have to do something illegal, like spread lies. But others take the manipulative intent view, which says that even a legal action, like sending a tweet, can be manipulation if your only goal was to artificially mess with the price.
And right there, that's the heart of the challenge for regulators. Musk's tweet wasn't a lie. GameStonk is, well, it's a meme, it's an opinion, so trying to prove in a court of law that his sole intent was to manipulate the price is an incredibly high bar to clear.
But that doesn't mean regulators are just sitting on their hands. They are absolutely trying to adapt to this new reality. They know the game has changed.
For instance, the SEC has evolved. They now have a special Cyber and Emerging Technologies unit, and its whole job is to police this new digital frontier, looking at everything from crypto to hacking to, yes, market manipulation through social media. This shows you exactly where their focus is.
But what they're really trying to do here is walk a very, very fine line. How do you protect the markets from being manipulated while at the same time protecting people's right to free speech? It's a fundamental challenge, and there are no easy answers.
So given how noisy and complex this all is, it really helps to have a mental framework to lean on. This isn't about predicting the market. It's just about bringing a bit of clarity to your own decision-making process.
The real question for any of us navigating this world is, in a market that's so driven by hype and emotion, how do you find the signal in all that noise? How do you maintain a clear perspective?
Well, here's a simple, non-prescriptive framework. A set of questions to ask yourself before you act. First, am I putting in more than I can truly afford to lose? Second, is this decision coming from a place of careful analysis, or is it pure emotion, like FOMO? And third, is the source of my information actually credible, or are they just trying to sell me something?
At the end of the day, here's the reality we have to accept. The dynamic we've broken down today, it's not a fluke. It's not going away. The link between social media and market volatility is now just a permanent feature of our financial world.
And that leaves us with one final big-picture question to think about. What happens to our financial systems when the speed of information completely outruns the legal frameworks that were built to govern them? That's the question that will likely define the next chapter of market regulation.